Welcome, everybody, to another episode of the Trusted Trustee podcasts. And I'm joined, as usual, by Tracey Besters. How are you going, Tracey?
I'm doing really well, Darin. How about you?
That's good. Not too bad. Surviving these strong winds in Sydney, but we'll get there. And of course, this episode is brought to you by Super Fund Property Valuations, ATO compliance in a click. If your SMSF accountant or auditor is on your back for a property valuation, just order an affordable report from the experts with ease by using the details on your screen now. And as I always say, valuations are going to be a massive, massive issue as we lead into 1 July 2025, should this Division 296 tax come in. It's already a key issue for the ATO, but it's about to ramp up if that legislation gets through. So a very valuable service there.
Absolutely.
Now, Tracey, we've been talking about getting your money out of super, obviously, in the previous episodes, and we're going to continue along those lines. Slightly different slant to it, but still on that issue. So we're going to actually talk about taking the minimum pension out every year. If you have a pension, you've obviously, as a trustee, got an obligation to take a minimum amount of money out on that pension every single year. Trace, maybe we can start by actually detailing the parameters, because these have changed a little bit in the COVID years and we've come back. So maybe we can just clarify what the parameters are right now.
Yeah, absolutely, Darin. And I think it's important to understand. So when you first start a pension or first commence a pension, you're actually entering into a contract with the trustee. So you as the member and you as the trustee, you're entering into a contract with yourself. Yourself and yourself to adhere to these conditions of a pension, right? So one of the conditions is that you are going to take the minimum pension each year. So if we have an account-based pension, which is our standard retirement phase pension that we've been talking about, then we've got minimum percentages and we have no maximum, or I should clarify, we've got a maximum of 100%. So we can take all of our money out as a pension payment if we choose to. And when I say money, obviously it's whatever assets that are sitting in the fund funding that. So remember, we can't take an in-specie asset out of the fund as a pension payment, so we'd have to convert it to cash, hence the concept of money here. So if we've got a transition to retirement income stream, just to remind everyone about this anomaly with the transition to retirement income stream, that doesn't sit in retirement phase, it sits in accumulation phase, and we have a maximum 10% on that one. So today we're really talking about our, if you like, our standard bread and butter account-based pension. So minimum percentages from 1 July 2024 for those pensions start at 4% if we're below 65, all the way up to 14% if we're above 95. I don't have any clients above 95 any longer, so I'm not having to deal with 14%, but certainly I've got clients that are up kind of in that 9% to 11% range, which is a fair chunk of money that has to come out as a pension payment. So, and when we're talking about that percentage, what we're basing that percentage on is whatever the account balance is in those pension accounts as at 1 July 2024. So it's not what's in the overall SMSF unless we're 100% in pension phase or retirement phase, I should say. So it's whatever is sitting in those pension accounts. Now, there has been some confusion, I think, with trustees and members of SMSFs around what is an account. Now, we're not talking a separate bank account here, are we, Darin? It's not a separate
we
account. We're really talking about how it's divided up on paper, if you like. So it's not necessary, everything can be in one kind of bank account, if you like, but it's got certain components that sit within that account. So it's whatever's sitting in the pension accounts at 1 July 2024. when we had COVID measures, so we had some measures that came in COVID, and certainly they also were in play back when we had the GFC. A little bit of an acronym there from all of those years ago. Showing my age a little bit with this one, but you know, we did have some 50% reduction. So if your normal pension minimum was 4% during the COVID years and way back in the GFC days, that was kind of reduced down to 2%, and I think we had a 75% or 25% reduction somewhere in GFC as well. So, but right now we have no, thankfully, we don't have any COVID measures any longer. So we're at the standard minimum percentages, which start at 4%. So we've got to make sure that we take out that minimum percentage each and every year, as you said. Otherwise, we have a few issues.
Yeah, I think we're all thankful that we're back to normal now, so there should be no confusion over the minimum pension levels. And I do get it that people do get confused when there are these they're kind of like financial hardship measures, aren't they? Whereby if you're not able to generate normal levels of income, I suppose I could describe, in situations like the GFC or COVID, then the government came to the party and said, oh, okay, well, we won't impose such a high restriction on you. We'll reduce it by 50%. But again, with that comes the complication of remembering when that relief ends and when we get back to normal. But I think we can safely say, for the interim anyway, that we are back to normal. So don't think that any of those old rules apply, because they don't anymore. And obviously, the further we get away from them, the more normality there will be.
100%.
Now, of course, in making sounds pretty simple in practice, doesn't it, Tracey? Just make your minimum pension payment every year. But we all know that anything to do with SMSFs or superannuations, it's never really that simple, is it? And particularly probably with SMSFs, because we do know that there's a large cohort of trustees who do like to hold property in their super fund. But therein lies one issue. I mean, very easy to say, pay your minimum pension, but you have to have liquidity to do that. You have to have cash to do that, don't you, Tracey?
Yeah, you do, Darin. And as you know, as I said before, you can't make an in specie payment. So you can't take the bathroom door off your property and give it to yourself and say, well, here's your pension payment this month. You know, you can't do that. It has to be cash. And I think that was, you know, the part of the premise of those financial hardship or the, you know, the COVID measures and certainly the GFC measures in the past that came in by the government is because of the flow-on effect from a liquidity perspective. So if, for example, you've got commercial property in your SMSF, you were providing some rent relief to your tenants at that point in time, you're therefore not going to have as much rent coming into your SMSF. And so therefore you're not going to have as much cash to be able to pay out as a pension payment. So it definitely does kind of raise the whole concept of liquidity. And I think that, you know, tying back in the whole valuation component of this, Darin, into meeting minimum pensions, they're really tied quite closely together. Because if you have property, and you know, quite a lot of my super fund clients do have property in their super funds, the values of those properties have increased considerably over the past 3 or 4 years, considerably. And so that then does have a flow-on effect to the minimum percentages that those funds have to pay out as in terms of their pensions. So if you don't have enough liquidity, then you've got a few options, but you need to address it. You can't wait until the 30th of June and phone your accountant, or your accountant phones you, hopefully one which way or the other, and say, oh, oops, by the way, you know, I was supposed to take $85,000 out this year. I've only taken $84,500. You know, that'll be okay, won't it? Well, clearly it's not okay if the minimum is $85,000. So we really need to be mindful of this minimum pension requirement. And yes, at face value, tick the box, it's easy, you've got to take your minimum pension, no worries at all, that's all good and well. But as always, you know, if something happens, you can't meet the minimum pension, you don't have enough cash, then you've got to address it early. You can't wait until the 11th hour to be able to address this. So for my clients, you know, we start talking about this in March and April, May at the very latest. We do some number crunching. We make sure we've got the minimum covered. And if we don't have the minimum covered, then at least we've got, you know, a minimum of 6 weeks to be able to work out what we're going to do there. So as I said, there's a few options which I'm happy to talk about in a sec, but liquidity is so important. And I think as our property values go up and our asset values go up, which is obviously what we want. We don't want things going the other way. We want them to go up. But as that happens and as we age, we really need to address this liquidity issues to make sure that we can meet those minimum pensions and maximise the effectiveness of our self-managed super fund environment.
Yeah, this whole issue reminds me of a boss that I once had when I was working in the accounting field. He used to always tell me that cash was king. And I think in this situation, not all of it in cash, but there's an element of cash which will be king to make your minimum pension payment. So what can people, like, what are some of the things that people should look at, particularly if they've got a lumpy asset that's not going to be generating enough cash? What are some of the strategies and what are some of the preparations people can make to ensure that they don't fail this obligation they have?
Yeah, great question, Darin. And I think the Cash is King is a great name for a self-managed super fund. Cash is King superannuation fund. Sounds like a good one. I might set that one up myself. Probably one out there somewhere. But yeah, there's a few things, Darin. And I think that it's about understanding that there are solutions. So the first obvious one is that you sell down some investments, right? So you sell down some investments, you liquidate, you get some more cash. That gives you the cash available within the SMSF environment to be able to meet those pension payments. So that's the first one. The second one is that you could reduce the amount of the minimum required by doing a partial commutation of your pension account or your pension balance. So what that means is if you were to stop your superannuation pension in full, that would be a full commutation. And what that means on paper, at least, is that it transfers from retirement phase back into accumulation phase. And that gives you the opportunity to start a fresh pension if you wanted to from scratch. You don't have to do that though. You don't have to fully commute back into accumulation phase. You can do what we call a partial commutation, a partial stop of that pension. So you could work out, well, from a liquidity perspective, what I can actually manage to pay out in cash after I've funded everything in the SMSF is X amount of dollars, and work out what that percentage is, gross it back up, and then you'll know kind of what your account balance needs to be from a pension perspective in order to meet that minimum pension. So that's a possibility as well. There's a whole lot of paperwork involved with that. We won't go through that today, Darin. We'll bore everyone to tears with the administration requirements, but please note that there are a whole lot of administration requirements in order to do that, including transfer balance account reporting that is required to be done within a certain timeframe with the ATO. So you've got some requirements to meet there from a deadline perspective. But the other alternative, I guess, the third alternative is there an ability to contribute more money into the SMSF? So that kind of takes us way out of getting money out of super realm and getting money into super realm, which we haven't touched on in these podcasts yet, but we will. But can we actually contribute more money into super? Can we meet, are we covered with the age restrictions of contributing money into super? Do we have, enough fat in our total super balance in order to be able to contribute money into super? Because generally in these situations, we're looking at non-concessional contributions, Darin, which is, of course, our after-tax money going into super, not our before-tax money. So we're generally looking at that non-concessional. It's not generally funded by concessional contributions, although it can be, but most of the time it's those non-concessional. So we've kind of got three options there, contribute more money into super, do a partial commutation, sell down some investment in order to be able to generate cash. In my experience, it's generally all three are involved there. The last result we want to do is to sell down investments because that we might not be able to time the market in the way that we want to in order to be able to sell down those investments. The last thing you want to do is sell down an investment at the time where it's depressed in the market. You don't want to do that, and then you potentially liquidating a loss. But it's generally a combination of those three. So I would look at from a strategy perspective, I would look at contributing first, if that's a possibility. If that's not a possibility, partial commutation. If that's not a possibility, then looking at sell down an investment. So it's good to know that we have options though, right?
Oh, 100%. And of course, no option should ever be seen as mutually exclusive to everything else,
Sure.
Hence, the combination is probably a good solution. And of course, very pertinent for SMSF trustees, considering that they like direct shares and they like property. Well, the last thing you want to do is sell shares or property when the market is a little bit depressed, as you said, and they're probably the two things that go hand in hand that you really don't want to sell low, but can easily happen. Now, just a quick clarification, Trace, if you're going to make contributions, you can't contribute to the pension account, can you?
No, definitely not, Darin. So, to add to that, just to segue back a little bit there for a sec, you also don't want to be selling down your direct equities before they go ex-div as well. So, you want to time it, right?
Yeah.
Shares, you want to
100%.
get that dividend into your account. So it's all about timing there. No, you cannot add to a pension account once it's commenced. So, like I said before, you start this pension, you enter into a contract for this pension, and you actually you specify in that contract, that commencement of the pension contract, you specify how much money you're commencing that pension with. Or if it's not a dollar figure, it will say all of my account balance. It'll be some sort of specification of what you're actually commencing that pension with. Once that pension is started, it's commenced, you can't add to it. The only way to change that pension is to commute either partially or fully. Whatever that amount of commutation that goes back into accumulation, it gets added to whatever is sitting into that accumulation account, and then you go again with a new pension. So if you're making a contribution to super, it is going into your accumulation phase. Now, I wish I had a whiteboard in front of me because I would draw this, and I certainly will draw this at Trustee Empowerment Day, because I think it's really confusing for trustees around the division between the overall superannuation assets and their member balances. And the way that I draw it, I kind of draw a line across horizontally, and I put the members above the line and the assets below the line. Now, the super fund, subject to segregation measures, and we'll talk about segregation in another podcast, I'm sure,
Yes.
but subject to segregation measures, if we have an unsegregated super fund, which most of the super funds I see are unsegregated, which means that they're not specifying a specific asset for a specific member or a specific member's account. They're unsegregated. What that means is the super fund trustees can utilize any of the income that comes from any of those assets in order to meet their pension requirements. So that means anything sitting in accumulation or retirement phase can be utilised from an asset generation, income generation perspective.
Yeah.
Now, that's really confusing for members, and I get that that's confusing. So we've got to then look at, well, on paper, what do the member balances look like above the line? What do those member balances look like? And if my member balance says that I've got $1 million in my retirement phase, that's what I'm using to work out my minimum percentage, regardless of where that money's coming from to fund that minimum percentage of pension. So it is confusing in terms of the division and the separation on paper versus the assets. As trustees of super funds, we often just think about, well, here are the investments, and this is what I'm going to do. I'm going to look at growing these investments and look at the income generation from these investments, and we leave everything else to our accountants and our advisors to work everything else out. And that's a smart move, by the way. That's a really smart, because we don't want to have to keep track of it, but we don't have to just think about these 5 share parcels are going to fund my pension. We don't think of it like that unless we've got segregation. We can look at overall. So that's why it's nice to draw a diagram. So for those coming to Trustee Empowerment Day, you'll have a diagram from me on how that actually works.
And what a great reason to go to the Trustee Empowerment Day. If nothing else, check out Tracey's diagram as far as this subject goes. Now, we've talked about the obligation itself, but I suppose people need to know what the incentives are to meet that obligation, and probably more importantly, what are the consequences if I don't meet them? And they really are quite serious, aren't they, Tracey?
They are, Darin. And, here's the carrot and the stick, right? So the carrot, let's talk about that first, because, optimistic person, we like to talk about
half glass full or glass half full.
Absolutely. So the incentive of having the minimum pension met is certainly that tax concessions, right? So if we've got the income generated by the assets that are supporting that pension are then taxed at 0%. Supporting the pension. So that's a massive incentive. That's a massive carrot. That's a massive incentive. We talk about this concept of ECPI, which is exempt current pension income. And this is where we've got these wonderful actuaries that run their numbers, not using an abacus is like the one behind me, but, they run these numbers to be able to work out the percentage of the income that will be tax-free within the SMSF. It's a massive carrot. So that's the incentive. If we meet our minimum pensions, we have this carrot. If we don't meet our minimum pensions, and we've had quite a tightening of the ATO's view and the regulator's view on this recently, if we don't meet our minimum pension, then we fail that, those conditions of that contract in that financial year, that we don't meet the minimum, we lose our ECPI in that year. So, quite a massive thing. But further to that, and, from June 2024, the regulator changed their tax ruling for this, we actually lose the status of that pension moving forward. So it's not just in the financial year that we fail to meet, but moving forward. So therefore, we no longer have a complying pension within that SMSF. So that's a massive stick. Massive.
It's a good segue to the change. This came in around June this year, that this tax ruling TR 2013/5, where it does deal with the starting and stopping of a pension, but in particular, one paragraph was changed to deal with what if you don't meet your minimum pension. Now, just a little bit of quick background. What used to happen was, I forgot, Tracey, my mistake. Sorry, I've lost ECPI for this year, but I've actually mended my ways, and I've already paid my minimum pension. We're in September now. I've already paid it, so I'm good for the next year. Now, the ATO used to apply the rules whereby, okay, Darin, well, if you've done the right thing in the subsequent year, great, everything's restored. That pension is active again. Off we go. Happy days. Like nothing had happened. Yeah, penalized for 1 year, but like nothing has happened. Well, this ruling has actually changed it, whereby if you do miss your minimum pension obligation, that pension is no longer going to continue in the future. So basically what it means is that effectively, in the eyes of the ATO, that pension has ceased to exist. Funnily enough, you've still got to put a formal commutation, like paperwork and procedures in there, but you actually have to then make a conscious effort to start a completely new pension, which will mean completely different valuation for the assets supporting the pension, and a whole myriad of other things, which we will go into during another podcast, because again, we go off piste, and there's so many things to unravel as far as these goes. But it is a significant change. We haven't heard a lot of people discuss it. You've probably heard it discussed for the first time here, actually, if you're listening to this podcast. But it is actually a significant change, and again, puts more emphasis on just make sure you get your minimum pension done.
Absolutely, Darin. And this was, this tax ruling is an old ruling. So it came out in 2013. So for those who don't play this game every day like we do, TR means tax ruling. And then you have the year of the tax ruling when it's released, and then the number of the ruling. So this is a 2013 ruling. It was the 5th ruling that was finalised in 2013, and we're in 2024. So not something that we would ordinarily expect to have quite a significant change in an old tax ruling like that. But the ATO, as the regulator in this space, have every right to amend their rulings if they want to. That's up to them. And they have just clarified that no, this is their position. They've, I think, given more certainty in a way around that position, even though I don't like the position. I think it was much more flexible before, but that's up to them to put that certainty in, and to put the boundaries around what their view is on the commencement and the cessation, more importantly in this regard, of an income stream.
And it's a weird one because the update to that tax ruling was supposed to be just to address some total super balance issues and transfer balance account issues, just to allow, you know, most of the rules to fall in line with each other, so there wasn't any sort of contrast or conflict between, but this rule says this and this rule says that.
Yeah.
And interestingly enough, just to give listeners and viewers a bit of an insight into how some of these things work, before you go to your accountant and say, but hang on a minute, why didn't you know about this? You know, they wouldn't just drop this upon us without any warning. Well, in this situation, they actually have, because they did produce a draft update, and the offending paragraph only had one word change in it. So effectively, the draft was business as usual. Yeah, it was one word, but it wasn't a significant word that changed. And then lo and behold, when they finally dropped the update as it stands now, which is the finalized version of it, paragraph 20 introduced more than a one word change. It was a whole myriad of word changes, and it's led to this situation, which again, we don't have enough time to go into, but certainly the ramifications are extremely serious.
Absolutely. So I think, Darin, you know, as I mentioned before, with my clients, I'm looking at their minimum pension payments as to what they've made in March, April, May. With this particular tax ruling, I think it's much more important to get on that even earlier. So for any of our, you know, podcast viewers or listeners, if they have a minimum pension concern, you know, they've got this pension, maybe their asset valuations at 30 June 2024 have gone up considerably. You know, they have got a question around whether they can meet that minimum pension for the 2025 year. Then now's the time, I think, really to be talking to their accountants and advisors around, well, what does this look like for me? Because, you know, if we've got this, you know, this automatic, if you like, automatic cessation of a pension if we haven't met the minimum, then not only do we have to start again, we will be starting again potentially with different tax-free and taxable components. Again, a whole other conversation to have, but just be aware that we've got a taxable, tax-free component of every account balance that we have in a super fund. We don't necessarily want to muddy those waters if we've, you know, had quite a lot of tax planning around those pensions to start with from an estate planning perspective, but also if we've got some older pensions, and some of these pensions, you know, will have been around for quite some time, then we did have some grandfathering of age pension assessment and Commonwealth Seniors Healthcare Card pension assessments, not pension, Commonwealth Seniors Healthcare Card assessments. And so by creating a new pension now, you may lose some of the grandfathering of those things. And one thing in my professional career, Darin, that I've learnt not to do is mess with somebody's Commonwealth Seniors Health Card.
No,
so we don't want to go down that path.
No, to a person, all of the practitioners I speak to, Tracey, tell me that the Commonwealth Seniors Health Card is something that you cannot compromise whatsoever.
Exactly.
Even though it may seem inconsequential to the practitioner or the expert, to the individual trustee, it is one of the most important things, and I fully get that. You know, if that's what's important to you, then that's what's important to you.
Absolutely, Darin. So the message of this is starting a pension is not set and forget.
No.
Along with everything else in an SMSF, it's not set and forget. You are entering into this contract. So you have contractual obligations, just like any other legal contract that you would have in any other part of your life. You must make sure that you adhere to these requirements. One of those requirements being the minimum percentage. That ties back into our account valuation, because just because your minimum percentage was X amount of dollars 5 years ago when you commenced that pension, it won't be X amount of dollars today, because it's got to be based on whatever the valuation is of the assets that you have underlying within the SMSF. So the valuations are, of course, very, very important. Now, If I was to commence a pension today, then I need to actually look at what the value of my assets are as of today, not 30th of June. So it's only where we've got ongoing pensions that we're looking at our 30 June, 1 July balances. If I'm starting a pension today, then I'm looking at today's balances and today's valuation, not from a few months ago. So we've got to understand that, there's such a flow-on effect with valuations and such a flow-on effect with, when we commence these pensions and when we stop these pensions. It's not just a matter of, clicking your fingers, as I always say, and it's a done deal. We've got to look at the impact and what that flow on is across the board. So make sure that minimum pensions are paid, and you will avoid the grief that we're talking about, that big stick.
And of course, one of the key takeaway messages, this is one of our key takeaway messages in just about every episode, I think, is don't wait until the last minute to do it.
Please don't.
Get your obligation done as early as possible. Then it doesn't matter. It's squared off. It's squared away. Yes, I know that manage your liquidity, but make sure you get it done as soon as possible because it's squared away. You don't have to have on the 29th of June figure out, what can I do now? I haven't paid it. Don't. It's not like cramming for an exam. Get it done as soon as possible. And that actually applies to a lot of things, SMSF.
100%. I don't think your accountant will answer your phone at their phone at 29th of June if they receive the message. By the way, my minimum pension, what am I going to do? Sorry, buddy, you should have talked to me about it earlier. No, look, it's a two-way street. And, accountants certainly don't jump on your accountants about that tax ruling change either. Like you said, Darin, it was a very slide that under the radar kind of change that the ATO put into that tax ruling around the implications of not meeting the minimum pension. So, but certainly now's the time to be having that conversation with your advisors and making sure that you're not going to have that problem for the 2025 year.
Yeah, it was a sneaky one. It was almost like one of those government announcements that are done on, at 4 o'clock on a Friday afternoon when everybody's knocked off to go to the pub anymore. So it doesn't get any coverage because no one's really paying attention on a Sunday morning or something like that. It was almost literally like that. It really did sneak under the radar. So don't go harsh on anybody that you speak to about this because it snuck under their radar as well. But you will no doubt be hearing more about it, and you'll be hearing more about it from us because we didn't have enough time to go into the ins and outs of it. But as I said, it is a significant change. So before we wrap it up, I just wanted to remind you that Tracey will be talking about this subject in a lot more detail at the Trustee Empowerment Day. It's being held in Sydney and Melbourne on the 17th and the 19th of September, respectively. If you want to come along, please register for the event using the details that you can see on your screen right now. And of course, if nothing else, you should come along to actually see Tracey's diagram that she referred to earlier. She can even write it on a whiteboard and you can take a snapshot of it so you can have something to take home with you. It's like the old kids' lollies bag after a birthday party.
Absolutely, Darin. It's one of those, those little things. It's one of the carrots, right?
Yeah, absolutely. Absolutely. It's an incentive to come. But look, otherwise, thank you again, Tracey, for doing another one of these podcast sessions with me. Your knowledge is invaluable.
Thanks, Darin. I'm really enjoying doing them with you as well.
And thank you again to our sponsor, Superfund Property Valuations. But of course, thank you to the listeners and the viewers. As usual, we hope that you've enjoyed the podcast as much as we've enjoyed bringing it to you. Again, I'll give a shout out to anybody who's enjoying our content on our YouTube channels. Please hit the like button and subscribe to the channel because that will get some of our measured matrix up. But apart from that, thanks again for your company. And we look forward to being with you on the next episode of the Trusted Trustee podcast.
Thanks, Darin. See you next time.